Right now, as you listen to this, thousands of people are literally paying for the privilege of working for a trading firm.
Yeah, which is kind of wild when you frame it like that.
Right. I mean, think about that for a second. They aren't getting paid a base salary.
Yeah.
They aren't getting health benefits.
No, not at
And
all.
they don't even get a desk to sit at. Instead, they are paying an upfront fee just to take this highly restrictive standardized test.
And, statistically speaking, over 90% of them are going to fail.
Exactly, over 90%. Yet, despite that brutal mathematical reality, this is basically the absolute fastest growing sector in retail finance today.
Oh, without a doubt, it's exploded.
Because the modern prop firm, quote unquote, promises that if you pass their test, they'll just hand you a $100,000 trading account.
Yeah, that's the big hook.
But what if I told you that, in many cases, that money doesn't actually exist?
See, that is the really jarring contradiction at the heart of this entire industry right now.
Right.
We're looking at a phenomenon that has completely hijacked the financial narrative online. I mean, it's incredibly seductive
It really is.
because it promises to solve the single biggest hurdle that, every aspiring retail trader faces.
Which is just a total lack of capital.
Exactly. But the underlying architecture of how that capital is provided, well, and whether it's even real capital to begin with, is vastly more complex than the marketing suggests.
Which is exactly why we're pulling this entire machine apart today. Our guiding document for this deep dive is a phenomenal piece of research that just came out.
Yeah, the June 2026 white paper.
Right, published by the Elite Solutions Sweden research team. It's titled Retail Prop Trading Under the Microscope.
It's a great read, really thorough.
Yeah, so we are setting aside all those Instagram reels of, like, the rendered neon green luxury cars.
Please.
We're ignoring the screenshots of massive life-changing payouts that people post on social media.
Right, because we're using this paper to conduct a rigorous evidence-based investigation into the actual underlying economics.
The hidden business models.
Exactly, and the behavioral psychology of the funded trading industry. Because the Elite Solutions Sweden paper is particularly valuable since it completely bypasses all that emotional noise of the internet.
It's definitely not an opinion piece.
No, and it certainly isn't a marketing funnel for some trading course. It treats the retail prop firm industry as a true macroeconomic subject.
Right, dissecting that structural tension between what is being sold to the public and how the revenue is actually generated behind closed doors.
Which is a huge distinction.
And I should probably lay my cards on the table right away, because we are approaching this from two slightly different angles.
We definitely are.
I tend to lean a little toward the excitement of the democratization of finance. I mean, the traditional avenues of high finance have always been guarded by these massive iron gates.
Sure, very exclusive.
The idea of opening up global markets to the masses, like giving someone who maybe didn't go to an Ivy League school a real shot at managing actual capital.
I get the appeal.
Conceptually, that's a beautiful thing. Right. It feels like a real leveling of the playing field.
The concept is undeniably appealing, I'll give you that. However, my analytical background forces me to kind of be the skeptic in the room.
Natural.
When I look at this industry, I don't really look at the democratization narrative. I look purely at the structural economics.
The numbers.
Exactly. I look at the balance sheets, the terms of service, the risk parameters, and I constantly ask, where is the actual money coming from?
Which is the million-dollar question.
Because when you dissect the mechanics of how these modern firms operate, you start to find that the leveling of the playing field might just be an incredibly sophisticated illusion.
So to figure out if it's an illusion or a genuine opportunity, we have to kind of trace the bloodline of this industry.
Right, we have to look at the history.
How do we get to a point where a teenager sitting in their basement can supposedly trade $1 million account?
Well, the white paper lays out this evolution beautifully. It breaks the history of proprietary trading down into 4 distinct phases.
And we really need to sit with this history for a minute.
We do, because understanding the traditional institutional model is really the only way you can spot the structural anomalies in the modern retail model.
So the timeline begins with what the researchers call the institutional phase.
Yeah, and to picture this, you kind of have to mentally travel back to, like, 1980s and 1990s Wall Street.
Right, the classic era of Salomon Brothers.
Or the early days of Goldman Sachs's proprietary desks. In this era, prop trading had a very literal, strictly defined meaning.
What was it?
A financial institution was trading its own balance sheet capital directly into the market to generate a profit for the firm itself.
So they weren't executing trades on behalf of clients.
No, they were trading the firm's money. Pure and simple.
And the people executing those trades were employees in the truest sense of the word.
Absolutely.
I mean, they had base salaries, they had massive research desks supporting them with macroeconomic data.
And they had risk managers literally standing over their shoulders on the trading floor.
That physical proximity seems key.
It is key. The risk management was institutional, the capital was undeniably real, and the timeline for profitability was often measured in quarters or years.
It's not days or hours.
Exactly. If a firm hired a quantitative analyst out of MIT, they were investing heavily in that individual's long-term development.
So the barrier to entry was just incredibly high.
Elite degrees, aggressive hiring processes, proven track records. It was a completely closed ecosystem where massive pools of real capital were deployed with the expectation of actual market returns.
The firm's profit was derived entirely from extracting money from the global financial markets.
Right, so that's phase one. An exclusive club with real money.
Okay, then the internet happens and we hit phase two, the electronic transition.
Yes, the physical trading floors start to quiet down and the action moves to server racks.
Suddenly, we have ECNs, electronic communication networks, algorithmic execution, real-time market data bouncing around the globe through fiber optic cables.
Right, the technology democratized the information.
Which is huge.
The information, yes, but not the capital.
Oh.
That is the crucial distinction the white paper makes. The technological leap in the late 90s and early 2000s meant that the barriers to acquiring market data just plummeted.
Right, so someone sitting in their living room in Ohio could suddenly see the exact same bid-ask spread on a currency pair as a trader sitting in Manhattan.
The playing field of information was leveled, yes.
Which feels like progress.
It is, but seeing the prices and having the power to move them are two entirely different things. And something else critical happened during this electronic transition that set the stage for the future.
What's that?
As trading went digital, the institutions realized that order execution wasn't the only valuable asset. The digital footprint of the trader became a commodity.
You mean the order flow itself, like the data of who is buying, who is selling, and at what price?
Precisely. The flow of retail orders began to be aggregated and analyzed. The market learned that human behavioral data, when aggregated at scale, was immensely valuable.
Oh, wow. Okay.
Keep that in the back of your mind, because the monetization of behavioral data becomes a really central theme later in this research.
I will definitely circle back to that. But for the moment, the primary takeaway of the electronic transition is that technology allowed the public to see the market, but it didn't give them the millions of dollars needed to participate at an institutional level.
Exactly, which logically forces the birth of phase three, the retail expansion.
The early to mid-2000s.
Right. This is when the gates open wide for the retail participant. The era of online forex brokers, CFD providers, and eventually, the zero-commission stock trading apps on our phones.
Like Robinhood and all those. Now, anybody with a Wi-Fi connection and $50 could open a brokerage account and execute a trade in the live global markets.
But here is the massive friction point. You are only trading your own $50.
The capital constraint remains the unbreakable ceiling.
Exactly. The retail expansion gave everyone a portal to the market, but it didn't solve the fundamental mathematics of compounding returns.
Right. Let's say you are an incredibly talented retail trader. You've spent years studying market structure. You have ironclad discipline.
A rare breed, but okay.
And you managed to generate a 20% return in a single month. In the institutional world, a 20% monthly return on a $50 million portfolio makes you a legend.
You earn a massive bonus.
But in the retail world, if you're trading a $1,000 account, your spectacular world-class 20% return nets you $200.
Which is, you cannot escape the velocity of gravity with that amount of capital.
$200 doesn't pay the rent. It definitely doesn't change your life.
And this creates a profound psychological frustration for the retail trader. They have the tools, they have the access, they might even have the genuine skill.
But the sheer lack of leverage renders their efforts economically insignificant.
Exactly. And that deep, widespread frustration is the incredibly fertile soil where phase 4 of the evolution takes root.
The funded trading phase. The birth of the evaluation-based access model.
Which we now just call the modern retail prop firm.
Right. So, listening to this evolution, an analogy popped into my head to make sense of this shift.
Let's hear it.
Think about the financial markets, like the world of elite motorsports. During the institutional phase, only the professional race car drivers, directly employed by a team like Ferrari, are allowed anywhere near the Formula One track.
Okay. A heavily guarded, capital-intensive environment.
Right. Then, the electronic and retail phases happen. Management decides to open the gates to the track. They announce that anyone from the public can drive on the official Formula One circuit.
Sounds fun.
But they only give you a golf cart to drive. That golf cart is your personal retail capital. You are technically on the track, you are experiencing the turns, but you are not competing.
You are getting laughed by the institution.
Exactly. Then along comes the modern retail prop firm. They set up a tent outside the track and say, hey, you don't have to drive that golf cart. We will give you a hyper-tuned $1 million race car to drive on this track.
But first...
Right. But first, you just have to pay us a small fee and pass our standardized driving test.
That is a brilliant way to conceptualize the marketing pitch, but this is exactly where the Elite Solutions Sweden research forces us to push back.
Really? How so?
Well, the analogy holds up for the marketing, but it falls apart when we look at the structural reality.
Walk me through it.
In your analogy, the firm is actually handing you the keys to a real race car. The white paper's core insight is that market access expanded, but access to real institutional capital did not.
Wait, so what are they giving you?
The modern retail prop firm is not handing you a race car. They are putting you in a highly conditioned, heavily restricted driving simulator that merely looks and feels like a race car.
A simulator.
Mm-hmm.
So the transition isn't just about who gets the money, it's about whether the money is even interacting with the market.
Exactly. The paper makes a razor-sharp distinction here that changes everything. Traditional proprietary trading runs on real capital and employment. Retail proprietary trading runs on conditional access and evaluation fees.
Okay, let's look at the economic engine of a traditional firm first.
The flow is linear. The firm provides capital, which leads to trading activity in the live market, which leads to market performance, which ultimately generates profit.
The profit comes from the market. The firm's success is tied directly to the trader actually extracting money from the stock exchange.
Yes. But the retail prop firm model flips that engine entirely upside down.
How?
In the retail model, the firm is not primarily making its money by taking its own massive pool of capital, handing it to untested retail traders, letting them risk it in the live market, and hoping for a cut of the profits.
I mean, that would be an act of financial suicide, right?
Complete financial suicide.
So if these firms aren't taking my trading expertise, letting me trade their real money in the live market, and taking a cut of the profits, how are they affording all this?
Right.
How has this exploded into a billion-dollar industry that sponsors major sporting events and dominates our social media feeds?
The multi-million-dollar question. And answering it requires us to step out of the trading mindset and into the mindset of a venture capitalist looking at a SaaS company.
Software as a service.
Okay, we have to unpack the underlying machinery of what the researchers call the challenge economy.
Let's pull the curtain back on the challenge economy, because the white paper spends a massive portion of its analysis dissecting the business model of these retail prop firms.
It does.
And honestly, the mathematics of it are mind-bending.
The fundamental paradigm shift we need to grasp is that the primary revenue source for the majority of these firms is not market profit.
Right.
The lifeblood of the company, the revenue keeping the servers running and paying for the marketing campaigns, comes from evaluation fees.
The entry ticket. You want the race car, you have to pay to take the driving test.
Exactly. A retail trader pays an upfront fee. Let's use $500 as an example.
Right.
They pay that to purchase a challenge. This challenge evaluates their ability to hit a specific profit target within a specific time frame without violating incredibly strict risk parameters.
Like losing a certain percentage in a day.
Right. If the trader fails to hit the target, or if they violate a rule, they fail the challenge. They lose their $500. The firm keeps the fee.
And the firm politely informs them that they are welcome to pay another $500 to reset the account and try again.
And behavioral psychology dictates that people do try again, over and over and over.
They get so close.
Exactly. The firm has shifted its revenue model to top-of-funnel marketing acquisition. The business imperative is no longer about finding the absolute best traders to manage a finite pool of institutional capital.
What is it about them?
The imperative is to generate a massive, never-ending volume of aspiring traders coming into the ecosystem, paying evaluation fees, and statistically speaking, failing those challenges and paying for resets.
Wow. The white paper highlights this as a profound structural tension. And when I was reading this section, I couldn't shake this feeling that I'd seen this model before in a totally different industry.
Tell me if this tracks.
Is this essentially the exact same economic structure as an audition fee for a massive Broadway play?
Walk me through the mechanics of the Broadway comparison.
Imagine a massive theater production company puts out a casting call for a new, highly anticipated musical. They blast advertisements everywhere saying, "We're looking for raw, undiscovered talent."
We will pay you $10,000 a week to star in our show.
Yes. You don't need an agent, you just need talent. But, and here's the catch, it costs $50 just to walk in the door and audition for the casting director.
Ah, so the barrier to entry is monetized.
Exactly. Now, if 100,000 aspiring actors show up to audition, that theater company just generated $5 million in pure revenue before the curtain even goes up on opening night.
That's a lot of money.
Right. If the company realizes they can make vastly more money from the volume of audition fees than they ever could from selling tickets to the actual play, what is their incentive to ever actually cast anyone in this show?
That's a great point.
The structural tension is that they are financially incentivized to make the auditions so impossibly hard that everyone fails, but they keep the fees. The product being marketed is the starring role, but the revenue engine is the failure of the actors.
The mechanics of your analogy align perfectly with the cynical, structural view of the prop firm industry, and it's a very valid, mathematically sound concern to raise.
Because if the primary revenue is failure, why allow success?
Right. However, to maintain a balanced perspective, which the Elite Solutions Suiting team is very careful to do throughout their research, we have to look at the nuance of the ecosystem.
Okay, let's hear the nuance.
The consensus among the researchers is that legitimate top-tier firms actually do want a percentage of successful traders.
Really? Why? If the failure math is so lucrative, why let anyone pass the audition?
Two primary reasons, and the first one is entirely marketing-driven.
Back to the top-of-funnel acquisition.
Exactly. If a firm operates for a year and nobody ever gets funded and nobody ever receives a payout, the retail trading community will catch on almost instantly.
Yeah, the internet is ruthless when it comes to exposing scams. Financial Twitter, Reddit, they would tear them apart.
They absolutely would. So a prop firm desperately needs a subset of successful traders to post genuine payout screenshots, to do video interviews about their success, and to flex their lifestyle.
They need the social proof.
Those successful traders become the fuel for the top-of-funnel marketing machine. They are the proof of concept that keeps the thousands of new evaluation fees rolling in.
Okay, that makes sense. They need some winners to prove to the masses that the casino is beatable. What's the second reason?
The second reason is that in the more mature hybrid models, there is legitimate profit sharing on the back end if a trader is genuinely skilled and survives the evaluation process.
So they do want good traders.
If a trader can consistently pull profits out of the market, a firm is happy to take their split of that genuine alpha. But, and this is the crux of the chapter, the mathematical reality of the business model still relies intensely on massive trader attrition.
They still need people to fail.
They need the vast majority to fail to subsidize the entire operation. And this reliance on attrition is where we have to talk about the most brilliant marketing trick in the modern financial world.
I think I know what you're talking about. The difference between displayed account size and actual economic exposure.
Yes.
When I read this part of the paper, I honestly had to read it twice. It completely reframed the entire value proposition. Let's break this math down carefully.
Okay, so when you see a targeted advertisement for a $100,000 funded account, human psychology naturally dictates your assumption.
Right. You assume you are taking a test to be handed $100,000 of buying power. You visualize managing a 100-gram portfolio.
But you aren't. We have to look at the explicit rules of the challenge to find the true account size.
Let's run a hypothetical scenario to make this concrete for everyone listening.
Typically, a $100K challenge account will come with a maximum total drawdown limit of, let's say, 10%.
Okay, 10%.
That means if your account balance ever drops below $90,000, you have breached the risk parameters. The account is immediately terminated, you lose the funding, and you have to buy a new challenge.
Okay, so I start with $100,000 on the screen. If my equity hits $89,999, I'm out.
Think about the mathematical reality of that rule from the firm's perspective. The firm is never at any point actually risking $100,000 of capital.
Right.
The absolute maximum risk exposure the firm faces before the automated system shut the account down is $10,000.
Wait, if I have a 10% drawdown, I don't actually have $100K of buying power. I have $10,000 of wiggle room wrapped in $90,000 of phantom leverage. Am I reading that math right?
You are reading it perfectly. The real account size is only the drawdown limit. You are essentially trading a $10,000 account that has been mathematically engineered to allow for massive, oversized positioning.
Wow.
But human psychology, being what it is, the trader looks at the screen, sees $100,000, and trades as if they have a $100,000 cushion.
They size their positions based on the big number, not the small number.
Exactly. If you risk 2% on a trade thinking you have 100 grand, you are risking $2,000.
But if your actual survival threshold is only 10 grand, that single trade just risked 20% of your true account.
Right. And this cognitive dissonance leads to rapid, inevitable failure. The firm markets a massive, flashy number to attract you into the funnel, but they limit their actual economic exposure to a tiny fraction of that number.
That is just staggering. So if the firm is only risking 10 grand on the back end, but they are raking in millions of dollars in evaluation audition fees on the front end, who are these people paying the fees?
Well,
Because the structural math tells us that the vast majority must be failing, but the Instagram feeds tell us everyone is winning and buying sports cars. Let's look at why those two realities don't match up.
the white paper calls this the mirage of the funded trader. Chapter 4 of the research tackles this disconnect head-on.
How do they approach it?
It begins with a philosophical and statistical question. How do we actually define success in this industry?
That's tricky.
Because the narrative online completely conflates passing an evaluation challenge with becoming a consistently profitable career trader. And those are two fundamentally different things.
And the industry's complete lack of standardized reporting really clouds the water here. It's almost impossible to get a straight answer on failure rates.
It is entirely opaque. A prominent firm might post a massive banner on their website boasting, "We have 50,000 funded traders globally." That sounds incredibly impressive.
Sure does.
But what does that metric actually measure? Does it mean 50,000 people merely passed the 30-day simulation test? Does it mean 50,000 people managed to secure at least one profit payout before eventually blowing up the account?
Or does it mean 50,000 people are making a sustainable multi-year living trading this capital?
The white paper points out those are wildly different milestones, and the firms purposefully blur them together for marketing purposes.
Passing a challenge merely proves short-term performance within a very specific, constrained environment.
Exactly. Sustaining profitability over years proves long-term skill. Because the industry currently lacks a centralized, standardized way of measuring and reporting these success rates across different firms, it creates a massive structural illusion.
The researchers identify this as survivorship bias.
Yes, survivorship bias.
We need to explain this bias, but let's not use the old cliche of the World War II bombers.
Fair enough.
Let's apply this concept specifically to how the social media algorithms in 2026 operate, because the algorithm is the actual engine of the mirage.
That is a much more relevant application. The concept of survivorship bias is that you make judgments based only on the data that survives a process, while entirely ignoring the data that failed and disappeared.
Right. So when you apply this to the modern TikTok or Instagram algorithm, the effect is multiplied exponentially.
Oh, massively.
The algorithm is designed to optimize purely for dopamine and retention. It wants you to stay on the app.
Exactly. Imagine two videos are uploaded at the same exact time. Video A is a retail trader sitting in his bedroom looking exhausted, explaining how he just failed his 5th evaluation challenge, lost his $500 fee, and is giving up.
Bleak.
Now, video B is a 19-year-old trader standing in front of a rented Lamborghini, flexing a $15,000 payout certificate and shouting about how easy the challenge was.
The user swipes past video A in 0.4 seconds because failure is depressing. It doesn't trigger dopamine.
Right.
But the user watches video B 3 times, saves it, and shares it with their friends because it represents hope and wealth.
And the algorithm immediately learns from that behavior. It suppresses the failure and mathematically amplifies the success.
The social media feed becomes entirely curated by survivorship bias.
It completely buries the vast, silent majority of participants who failed their evaluation, lost their fee, and quietly walked away. The algorithm mathematically deletes the failure from existence.
Leaving the consumer with a feed that suggests success is the norm, rather than the statistical anomaly.
Precisely.
Okay, I hear that, and I understand how the algorithm distorts reality. But let me push back a bit and play devil's advocate here.
Go for it.
Isn't trading just fundamentally hard anyway? If we look at traditional retail brokerage accounts, people trading their own money on E-Trade or Charles Schwab, The statistics are notoriously brutal.
They are.
We've all seen the warnings that 80 or 90% of retail day traders lose money. So why are we acting like the prop firm model is uniquely dangerous? Is the challenge economy actually doing anything differently, or is it just the nature of the beast that trading is hard?
It is absolutely true that the nature of the beast is unforgiving. Trading financial markets is inherently one of the most difficult cognitive tasks on Earth.
Right.
But the white paper clarifies a critical structural difference between traditional retail trading and the prop firm model. Traditional brokers do not explicitly gamify the experience, and they do not market success as a discrete milestone you unlock by passing a 30-day standardized test.
So the gamification factor, you're saying the structure of the test changes the behavior.
Profoundly. Traditional trading is an open-ended, infinite game. You manage your risk, you adapt to market cycles, and you try to grow your capital over time. There's no finish line.
Right, you just trade.
The prop firm model introduces a specific, time-bound, hyper-constrained challenge. It explicitly tells the trader, if you can just hit 10% profit in exactly 30 days without ever losing 5% in a single day, you win.
That structure fundamentally alters the psychological approach to the market. Success, when stripped of its broader context, becomes a meaningless metric.
Exactly.
What do you mean by context in this scenario?
Short-term performance passing a 30-day test is very often just a byproduct of a specific market volatility environment temporarily aligning with a trader's specific strategy.
Give me an example.
Let's say you have a trader whose entire strategy is based on buying aggressive intraday breakouts. If they happen to take their evaluation challenge during 3 weeks in May when the market is trending incredibly hard, they will absolutely crush the evaluation.
Because their strategy fits the market perfectly in that specific window.
Right. They will hit the 10% profit target in 2 weeks. They will look like a financial genius.
But they didn't actually gain long-term institutional skill. They just caught the right weather pattern for their specific boat.
Exactly. And when June rolls around, and the macroeconomic environment changes and the market goes flat, choppy, and mean reverting, that exact same breakout trader will blow their newly funded account in 3 days.
Because they can't adapt.
They had the right strategy for the right 30-day window, but they entirely lack the adaptability, the nuanced risk management, and the emotional discipline required for long-term survival.
The evaluation tested their ability to sprint for 30 days. It did not test their ability to run a marathon.
Oh, beautifully said.
Which leads us perfectly into the absolute core of this deep dive. Because why do so many traders who do have technical skill traders, who know how to read market structure, who understand macroeconomic data, who have spent years studying order flow, why do they still fail these evaluations at such a catastrophic rate?
Because when they enter a challenge, they are no longer just fighting the financial market.
What do they fight?
They are fighting an invisible, meticulously designed psychological tripwire built directly into the rules of the evaluation itself.
Chapters 5 and 6 of the paper argue convincingly that psychology, not technical analysis, is the real battleground of funded trading.
It absolutely is.
We really need to get into the weeds here and run some hypotheticals because these specific rules form the architecture of the psychological pressure cooker.
Let's do it.
Let's start by revisiting the concept of the drawdown, but focusing on the most aggressive version of it. The trailing drawdown, or the daily loss limit.
We established earlier that a $100 K count might have a total drawdown limit of 10%. But the real psychological killer, the mechanism that wipes out the vast majority of traders, is the daily loss limit.
How does that work?
Many firms stipulate that you cannot lose more than, say, 5% of your starting balance in a single 24-hour trading period.
Okay, 5% of $100,000 is $5,000.
Correct. But here is the critical detail. That limit is often calculated based on your intraday equity, not just your closed trades.
Hey, what does that mean in practice?
If your account equity dips below that $5,000 threshold for even a millisecond while a trade is open, the automated risk systems trigger.
Even if the trade eventually bounces back?
Yes. The trade is liquidated, the account is terminated instantly, and you fail the challenge.
Instantly. There's no margin call, there's no warning email, just a locked screen. Let's walk through a multi-day scenario to see how this breaks a trader's brain.
Let's invent a hypothetical trader. We'll call him an experienced retail trader who usually risks 2% of his account per trade in his personal brokerage account. He buys a $100 challenge.
Okay, he's ready to go.
It's Monday morning. He sees a great setup. He takes a trade, risking 2% for $2,000. The market immediately chops against him, hits his stop loss. He is down 2%.
A completely normal occurrence in trading.
Entirely normal. It's still Monday afternoon. He sees a secondary setup that meets his criteria. He takes the trade, risking another 2%. Unexpected news hits the wire, the market spikes against him, and he gets stopped out again.
Ouch. He is now down 4% on the day.
And the daily loss limit is 5%.
He is now exactly 1%, $1,000 away from violating the rule, losing his initial $500 evaluation fee, and failing the entire challenge.
The panic has to set in immediately.
The white paper labels this specific state evaluation pressure.
In a normal, traditional retail account, a 4% loss is simply a bad Monday. You close the laptop, you go for a walk, you review your journal, and you come back on Tuesday with a clear head.
But in a challenge account, you aren't just having a bad day, you are staring at the edge of a cliff. The structural constraint of the daily loss limit triggers a cascade of psychological traps.
The report mentions something called the early success effect. Let's say our trader doesn't lose on Monday. Let's say he wins big. What happens then?
The early success effect is rooted in overconfidence.
Right. Let's say our trader makes $7,000 in the first week. The profit target to pass the challenge is $10,000. He is 70% of the way there in just 5 days.
Wow, he's killing it.
The psychological trap springs. He thinks, I've got this in the bag. I am a genius. He relaxes his strict discipline. He decides to increase his position size just to cross the finish line a little faster.
Big mistake.
He takes a massive trade, the market turns against him, and suddenly he loses $4,000 in a day.
He just squandered his massive lead, which leads directly to the most destructive behavior in trading, revenge trading.
Yes, he realizes he just threw away a week of hard work. The daily loss limit is rapidly approaching because of the massive position size.
In a rational state, he would walk away.
But the evaluation pressure creates emotional fatigue. Instead of walking away, he doubles down. He takes a highly leveraged, entirely irrational trade based on pure emotion, desperate to make it all back in one swing.
Let me guess. The market ticks against him, he breaches the 5% daily limit, and the account is terminated.
Pure self-destruction engineered by the constraints.
You know, I picture this entire environment like being asked to defuse a complex bomb.
I like that analogy.
Your technical knowledge of the wires might be perfect.
Right.
You have studied the manual, you know the red wire from the blue wire.
Right.
In a quiet room, you could defuse it with your eyes closed. But in this prop firm scenario, someone is standing directly over your shoulder, shouting a countdown in your ear. 10, 9, 8.
Your hands are going to shake.
Exactly. The structural constraints and the time pressure cause a technically proficient person to make fatal errors they would never make in a calm environment.
The bomb diffusal analogy perfectly captures the central thesis of Chapter 5. The paper highlights the profound, unbridgeable difference between trading well and trading to pass an evaluation.
When a firm imposes a strict time limit, for instance, requiring you to hit a 10% profit target in exactly 30 days, it forces a state of artificial urgency.
You can't just wait for the perfect pitch. You have to swing the bat.
Exactly. You are forced to abandon patience, which is arguably a trader's greatest asset.
A highly skilled institutional trader might sit on their hands for an entire week doing absolutely nothing.
Just waiting for the macroeconomic data to present a high-probability asymmetric setup.
Right. But a retail trader with only 5 days left on their challenge timeline doesn't have the luxury of patience.
They will start taking suboptimal setups. They will cut their winning trades short just to lock in a few $100s to inch closer to the target.
They will force trades that simply aren't there in the market structure purely to hit an arbitrary metric before a deadline.
Okay, let me step back into my devil's advocate role here, because we want to look at both sides of the coin, and there is an argument to be made for these rules.
What's the argument?
Couldn't you argue that these constraints, the daily loss limits, the consistency rules, are actually excellent, necessary training wheels?
Training wheels.
Let's be honest, retail traders are notoriously reckless. They over-leverage, they refuse to use stop losses, they average down into losing positions.
True.
Doesn't a strict daily loss limit forcefully teach a reckless amateur how to implement real risk management?
That is the primary defense used by the industry executives. And there is absolutely a kernel of truth to it.
It forces discipline.
The rules do forcefully introduce the concept of risk management to people who might otherwise ignore it. But the counter-argument, which the Elite Solutions Sweden team details extensively, is that while these rules are brilliant at protecting the firm's capital, they fundamentally warp and disqualify completely natural, historically proven trading strategies.
How so? Give me an example of a valid strategy that gets broken by these rules.
Let's look at the mechanics of swing trading. A swing trader is looking at macro trends. They might analyze a weekly chart and decide to hold a position for several weeks or even months to capture a massive market move.
Okay.
By mathematical definition, a swing trader needs wide stop losses to give the market room to breathe, to account for daily noise and volatility.
Right, because markets don't go up in straight lines.
A professional swing trader might routinely experience a 6% drawdown on an open position over a few days before the macroeconomic thesis plays out, and the trade turns around to become a massive 20% winner.
That is a perfectly valid, historically proven, institutional-grade strategy.
But in a prop firm challenge.
In a challenge with a strict 5% intraday daily loss limit, that swing trader is instantly disqualified on day 2 of the trade.
Exactly. The automated system doesn't care that the macroeconomic thesis is valid long-term. It only cares about the short-term threshold. Furthermore, look at the other explicit restrictions mentioned in Chapter 6 of the paper.
Like the news trading restrictions and overnight holding bans.
Right. A lot of these firms stipulate that you cannot hold a trade open over the weekend, or you are instantly breached if you execute a trade within 2 minutes of a major economic announcement, like the non-farm payrolls or a Federal Reserve interest rate decision.
Why do they do that?
From the firm's perspective, this is a defensive measure. It prevents an unskilled trader from just throwing on maximum leverage and getting lucky on a massive, unpredictable news spike.
But from the skilled trader's perspective,
These rules surgically remove some of the most lucrative, predictable volatility from the market. By banning swing trading and restricting news volatility, the firm is forcing every single participant into a very narrow, high-frequency style of intraday, low-volatility scalping.
the structural reality is that they aren't cultivating diverse trading talent. They're optimizing for compliance to a very specific, high-pressure game that strongly favors the house.
Okay.
So, when you synthesize all of this, when you combine a massive business model built primarily on evaluation fees, with highly restrictive rules that psychologically pressure technically proficient traders into failing, it's a recipe for massive systemic friction.
Friction is a good word for it.
You have billions of dollars of retail money flowing into an opaque system where the vast majority of participants are mathematically and psychologically positioned to lose.
Right. And historically, whenever there is that much friction and opacity involving retail money, who eventually comes knocking at the door?
Our regulators.
Yeah.
And they rarely knock politely.
No, they do not.
Which brings us to the regulatory reckoning. Chapters 7 and 8 of this white paper dive deep into the legal gray zones, the regulatory landscape, and the ongoing industry consolidation.
And the mechanics of this get incredibly interesting because it challenges the very definition of what these companies are.
So what does the regulatory landscape actually look like here?
Well, it forces us to define what this industry actually is in the eyes of the law, separate from its marketing. The paper makes a very blunt foundational statement. The mere label prop firm does not confer legal status.
So just because a company buys a domain name and puts proprietary trading in bold letters on their homepage doesn't mean they are regulated the same way a Wall Street bank or a registered broker-dealer is regulated.
Exactly.
So if they aren't regulated broker-dealers, what are they legally classified as?
That depends entirely on what services are actually being provided under the hood, how the customer funds are handled, and what the structural clearing model is.
The structural clearing model.
Yes. The regulatory authorities agencies like the CFTC in the US or the FCA in the UK are beginning to look past the flashy marketing and asking, what is the actual mechanical execution here?
And this inquiry leads directly to the most critical yet least understood distinction in the entire industry, the difference between simulated trading and live market execution.
This is often referred to in industry jargon as B-book versus A-book clearing.
We really need to take our time and explain this distinction like I'm 5, because this is the exact moment where the illusion shatters for a lot of retail traders.
Okay, let's start with live market execution, which is the A-book model. This is the model that aligns with the democratization narrative we talked about earlier.
The real deal.
In a true A-book model, if you pass the evaluation challenge and receive a funded account, you are trading real capital.
Right. So when you sit at your computer and click buy on a stock or a currency pair, the prop firm takes your order and actually routes it to a Tier 1 liquidity provider, a major global bank, or an exchange.
They are genuinely putting institutional capital behind your specific trade into the live global financial market.
The trade actually impacts the global supply and demand of the asset, even if it's just a tiny fraction of a cent.
Exactly. In this model, if your trade is profitable, the money is extracted from the global market. The market pays the firm, and the firm pays you your agreed-upon profit split.
That sounds completely legitimate.
Yeah.
That is exactly what every retail trader thinks is happening when they buy a challenge.
Yes.
There's always a but.
Executing a true A-book model is operational complex, highly regulated, and requires massive pools of real liquid capital. So the reality is that many firms, especially the newer ones that exploded on social media, operate on a fully simulated trading model, the B-book.
Let me make absolutely sure I am following the mechanics of this perfectly. Are you telling me that if I am trading a simulated B-book funded account, my trades might never actually touch the live financial market?
That is precisely what I am telling you.
Wow.
In a fully simulated B-book model, you are trading on a closed-loop demo server. The prices you see on your screen reflect the real market, but your orders do not. Your trades are internal. The brokerage is acting as the counterparty to your trade. They're essentially the house. Your orders never interact with real global market liquidity.
Okay, my brain is grinding to a halt here. If my trades are just numbers on a demo server, and they aren't interacting with a real market, and I miraculously manage to make a $10,000 profit on my screen, how does the firm physically pay me my profits?
That is the big question.
Where does the real fiat currency come from if it didn't come from a hedge fund losing on the other side of my trade?
This is the mind-bending reality that the researchers confirm. In a fully simulated B-book model, the payouts to the tiny fraction of successful traders are often funded directly by the evaluation fees collected from the massive pool of aspiring traders who fail.
Wow. Let that sink in for a second. The money you receive as a payout didn't come from the stock exchange.
No.
It didn't come from beating a quantitative algorithm on Wall Street. It came from an internal pool of revenue generated by thousands of other retail traders failing their $500 evaluation challenges.
The firm is operating as a closed ecosystem, internalizing the risk and betting heavily on the statistical probability that the vast majority of participants will fail.
Okay, I have to ask the question that everyone listening is screaming right now. Isn't that just a Ponzi scheme?
It is an incredibly common reaction, and the optics are terrible, I agree.
The structure using new entrance fees to pay off the few winners sounds terrifyingly close to the literal definition of a Ponzi scheme.
But from a strict legal and mechanical standpoint, it is not inherently a Ponzi scheme. We have to be precise with the definitions.
Okay, define it.
A Ponzi scheme solicits investment capital with a fraudulent promise of a guaranteed return on investment, based entirely on bringing in new investors. The prop firm model does not solicit investment capital, and it explicitly does not promise a return.
It offers a performance-based contractual agreement.
Right. The evaluation fee isn't an investment, it's a purchase of a service. You are paying for the opportunity to perform a specific skill trading within specific parameters.
If you perform the skill successfully, the firm is contractually obligated to pay you.
And the source of the firm's funds used to pay you is their internal revenue, which happens to be derived primarily from evaluation fees. Legally, a company can use its revenue however it sees fit to pay its independent contractors.
So the mechanics of B-book internal clearing are not inherently illegal.
Not inherently. However, the profound lack of transparency about this mechanism is what causes massive systemic operational problems.
How so?
If a firm operates a simulated B-book, they are internalizing the risk. By acting as the counterparty to your trades, they are structurally betting against you. They need you to lose to remain profitable.
Because mathematically, they know the daily loss limit and the time pressure will break 90% of people.
Right. But what happens if the macroeconomic conditions change dramatically?
And more about that.
What happens if an unprecedented, highly trending market allows a massive cohort of retail traders to suddenly start winning consistently at the exact same time?
Oh, the firm is on the hook to pay them all, but they don't have the market profits to cover it.
Exactly. If the payout obligations to the winning traders suddenly exceed the incoming cash flow from the evaluation fees, the internal math inverts. The operational strain breaks the company.
They enter a death spiral.
And we have seen this happen repeatedly during periods of industry reckoning. High-profile firms suddenly freeze payouts, blame vague technical difficulties with their payment processors,
Lock their Discord servers, and disappear overnight, taking the retail traders' profits and fees with them.
And this systemic fragility is exactly why the regulatory authorities are circling the wagons.
Yes, regulators aren't just looking at the legal definitions, they are looking at consumer protection regarding deceptive marketing claims.
Because if you aggressively market yourself as providing access to real institutional capital, but you are actually just running a closed-loop simulation funded by failure fees, that is a massive transparency issue.
Regulators care about clear communication of risk, fair contractual terms, and most importantly, reliable operational systems that guarantee a trader gets paid if they follow the rules.
So the Wild West era of this industry, the hyper-growth phase where anybody could spin up a prop firm with a slick Instagram account, a white-labeled demo server, and aggressive affiliate marketing at that. That era is rapidly coming to an end.
The industry is facing a massive wave of consolidation.
Chapter 7 details this exact market consolidation. The weaker business models, the firms operating on razor-thin margins with absolutely no real risk management or A-book capabilities behind the scenes, they are failing.
They are being wiped out by market volatility and regulatory pressure.
What we are left with is a demand for a civilized, sustainable future for the industry.
Which brings us to the final horizon of our deep dive today. Out of the ashes of the Wild West, what does the civilized future of the funded trader actually look like?
Well, white paper outlines 4 potential future scenarios in Chapter 10. Let's walk through them.
Okay, what are the 4 trajectories?
The researchers identify continued growth and professionalization, increased consolidation of major players, greater regulatory influence, and technology-driven transformation. But the overarching theme across all 4 scenarios is a forced shift away from pure marketing-driven acquisition and a pivot toward operational transparency, robust risk management, and verifiable trust.
Because you can only burn the retail market so many times before the well dries up. The community gets smarter. They start demanding proof of payouts and proof of live execution.
Exactly. The report suggests that the operators who survive and dominate the next decade will increasingly resemble professional, regulated financial technology companies, not purely marketing-driven affiliate platforms.
They will have to prove their balance sheet stability.
Right.
I want to focus heavily on the 4th scenario, technology-driven transformation. Specifically, the paper's predictions regarding the role of artificial intelligence. How is AI going to transform an industry that is already entirely digital?
Currently, the evaluation process is a very blunt instrument. It's
Right.
binary. Did you hit the 10% profit target, or did you breach the 5% daily loss limit? Yes or no? But the integration of AI allows for deep, automated risk assessment, incredibly granular trader analytics, and behavioral performance tracking that goes far beyond simple P&L.
Give me an example of what the AI is actually tracking.
The AI isn't just looking at your winning and losing trades. It is analyzing the metadata of your behavior. It is tracking the millisecond latency between when your cursor hovers over the close position button and when you actually click it.
Identifying micro-hesitations.
Yes. It's correlating your position sizing with the time of day. An AI system can analyze your trading journal over thousands of micro decisions and realize this trader executes perfectly on Tuesday mornings during the London session, but their win rate drops by 60% and their position sizing becomes erratic on Friday afternoons after a losing trade.
Oh, this is fascinating. Changes the entire relationship dynamic.
How do you see it changing?
I envision this future as a massive shift in how the firm treats the trader. Right now, a lot of these B-book firms act like a hostile bouncer at a nightclub.
The bouncer analogy?
Okay, they stand at the door with a clipboard, and the second you violate the dress code, the daily loss limit, they just toss you out onto the street, keep your cover charge, and say, next.
It is a purely transactional adversarial relationship.
Right. But with AI and deep behavioral analytics, the firm could shift from being a bouncer to being an athletic coaching staff.
I like that.
Instead of just tossing you out, they use the data to actively develop you into a profitable asset. They could intervene in real time.
Right. The AI pops up on your screen and says, hey, our analytics noticed you are exhibiting the physiological and behavioral markers of revenge trading. You always lose money in this state.
We are dynamically locking your account for the next 2 hours to protect you from yourself. They actively build better traders.
I love the banter to coach analogy. It paints a beautiful, optimistic picture of what the industry could be and how technology could actually fulfill the democratization narrative.
But I'm sensing a but coming.
But I have to bring my skeptical structural edge back into the conversation here, based on the economic incentives we've spent the last hour dissecting.
Let's hear it.
Will firms use this incredibly powerful AI to actually help traders improve, limit their mistakes, and achieve long-term profitability? Or will the less scrupulous firms use this behavioral AI to dynamically optimize the difficulty of the evaluations, actively triggering the trader's known psychological weaknesses purely to maximize reset fee revenue?
Oh, wow. That is dark. But given the business model, it's a completely fair question.
Think about the mechanics. If an AI understands your specific behavioral psychology perfectly, if it knows exactly what market conditions cause you to abandon your discipline, a firm could theoretically route you to a simulated feed that subtly exacerbates those conditions.
Ensuring that the maximum number of people fail right at the finish line, prompting them to buy another reset out of sheer frustration.
That brings us right back to the ultimate structural tension. Are the incentives aligned, or is the house actively betting against the player?
And that is exactly why the ultimate conclusion of Chapter 10 in the white paper is that transparency and trust will become the only long-term competitive edge in this space.
As retail traders become more educated, as they understand the difference between A book and B book, they will demand to know how the algorithms work.
They will demand verifiable proof of live market execution. The firms that survive the regulatory purge will be the ones that open their books and say, here's our data, here's exactly how we make money, and here is how our infrastructure aligns our success with your success.
Trust, not flashy marketing, will be the ultimate differentiator.
Okay, we have covered an absolutely incredible amount of ground today unpacking the Elite Solutions Sweden white paper. We've gone from the gated origins of 1980s institutional proprietary trading to the hidden mechanics of the modern challenge economy.
We've explored the harsh statistical realities of success rates, the intense psychological pressure cooker of trail and drawdowns, the systemic risks of internal B-book clearing, and the looming regulatory and technological reckoning.
It is a complex, deeply layered ecosystem. But the opportunity it presents is real, provided you understand the conditions attached to it.
And I want to remind you, the listener, of the core truth highlighted at the very end of this research. Access to capital has genuinely never been easier. Anyone with an internet connection can buy a challenge today.
But access to lasting, sustainable success has not changed at all. The rules of the prop firm, the drawdowns, the time limits, they're just external constraints. Internal discipline remains the only real edge.
Whether you are trading your own $500 account or a simulated $100,000 prop firm account, the market is a mirror. If you cannot control your own psychology, the market will find a way to take your money.
Traders who approach these programs as a rigorous, unforgiving test of their own discipline and risk management, rather than a magical shortcut to instant wealth, are the ones best positioned to actually navigate and survive this evolving industry.
Very well said.
Before we go, I want to leave you with a final, somewhat mind-bending thought to mull over. Something that builds directly on what we discussed earlier regarding the electronic transition, order flow, and the future of AI.
I'm intrigued.
Think about the data generation we just talked about. If millions of retail traders around the world are taking these challenges every single day, interacting with simulated markets, they are generating billions and billions of incredibly granular data points on human decision-making, fear, greed, market reactions, and failure.
They are creating the largest repository of behavioral financial data in human history.
The digital footprint of the retail crowd.
Exactly.
What if the prop firms of the future aren't really in the business of funding traders at all? What if the evaluation fees are just a brilliant mechanism to get you to actually pay them while you generate this highly valuable data?
That is a wild thought.
What if they are entirely in the business of harvesting your trading data, your micro-hesitations, your successes, and your failures to train their own infallible institutional AI trading algorithms? If that's the real end game, are you the trader or are you the product?
That is a profound question to end on. It entirely reframes the purpose of the whole ecosystem.
It really does. Keep asking those structural questions, keep looking past the marketing, and as always, keep learning. Thank you for joining us on this deep dive into the real mechanics of retail prop trading.